Hello and a warm welcome to another edition of Econoday Unplugged. It's Tuesday, the 7th of June, 2022. Terry Sheehan is on the US East Coast and I'm Jeremy Hawkins in London. At the start of the year, consumer price inflation in the Eurozone was running at 5.1%, or fully 2.4 percentage points less than the US CPI rate. But that gap has now almost closed. As of May, Eurozone inflation had climbed to 8.1%, and this Friday, the US rate is expected, according to Econoday's consensus, to ease a tick down to 8.2%. If so, we'll be very close to seeing US inflation slip below its Eurozone counterpart for the first time in 6.5 years. And yet, while the Federal Reserve has already hiked its Fed funds target by some 75 basis points in 2022, clearly signalled more to come, and earlier this month started passive quantitative tightening, the ECB's key deposit rate has remained steadfastly unchanged and indeed at minus 0.5%, well below zero. Moreover, its quantitative easing programme is still ongoing and is scheduled to pump a further 20 billion euros of liquidity into the domestic markets in June. So the contrast between the two central bank stances could hardly be more marked, and it's certainly hard to believe that both have got it right. So let's go to Terry then first for an update on the US economic situation and what the Fed will do next. And I guess we should kick off with last Friday's employment report. So what did that tell us about how growth is shaping up this quarter?
Well, so far, it looks like the U.S. economy continues to hold up pretty well. We added 390,000 jobs in May. There are some small but useful hints that the labor force is starting to expand. The unemployment rate held at 3.6%. Wages are continuing to go up, although not quite as quickly. And the job gains appear to be pretty widespread. So as far as the labor market goes, the U.S. economy is looking pretty good. Early GDP forecasts for the second quarter suggest growth somewhere a little below 2%. So at the moment, things look pretty good, of course, with the exception of inflation pressures.
Right. I mentioned in the intro about, so you got your numbers out on Friday. I mean, if the market's right and it is going to come down, I mean, are we anywhere close to the top of the inflation peak, do you think, in the inflation cycle, I should say, in the States, or is it far too early to say that?
I think it's a little early to say that. We had seen some hints in the March and April data that inflation might have topped out. That was encouraging, but all of a sudden now we've got record gasoline prices again in the US. We've got hints that consumers are preparing to pull back in their spending because they simply don't have the discretionary income they did. It just may push the consumer price inflation up higher again in May, where we saw the start of another round of price increases for energy.
Okay, well, let me ask what this means for the Fed. If I just quote Mr. Powell at you from, I think it was the middle of last month, remember rightly? He said to quote him, what we need to see is inflation coming down in a clear and convincing way, and we are going to keep pushing until we see that. So I mean, reading between the lines, what do you think does that actually mean? How far does inflation have to come down, be it to a level, how quickly it's got to come down or whatever, before the Fed would decide, well, okay, perhaps we've done enough with interest rates now?
I certainly think they would have to see at least 3, maybe 4 months of a downward trend in inflation to be convinced. We heard a lot from a number of Fed policymakers in the last week, just before the communications blackout period before next week's FOMC meeting. And even the most dovish were saying 50 basis points increases maybe through September, maybe longer. The push to aggressively address inflation through monetary policy is clearly a unanimous thing on the FOMC.
Okay, that leads us to the FOMC. I was going to ask you about that. Quick look ahead, and you probably kind of answered it already, I guess. But from what you're saying, it seems if so 50 basis points at least for the next two meetings. Is that kind of nailed on, do you think? And then they'll have another bit, or indeed, do you think now we're getting to the stage whereby it's almost independent of the data? They've decided, well, look, we've got to get interest rates up to 2.5% plus, or whatever it may be, and we're doing that almost kind of irrespective of what the data actually say.
I don't think they'll ever ignore the data, but the last FOMC meeting minutes, they did indicate that they want to get rates somewhere near neutral, wherever that is. 2.5% is a commonly bandied number, and maybe go past that, which I think took people by surprise. But I think they will still base policy on the data. And at this point, I think at least 250 basis point increases at the next two meetings, strong indications of a third 50 basis points at the meetings after that. So I think the Fed is really trying to send out the message that fighting inflation is their main priority in monetary policy right now, and that they are not going to let up until they're convinced it's under control.
Okay, fair enough. And certainly from terms of my question, let's ask you about the consumer sector again, since it is such an important part of, well, pretty well any economy, really. We'll have an update on consumer confidence or sentiment on Friday as well. What's expected to come out of that? And say you're talking up the economy. Is that likely to support that view, or will it still raise some doubts that perhaps growth could be slowing?
I think that consumers' confidence has not matched the actual performance of the economy. Consumers have a lot to worry about. There is nothing that will drive consumer confidence indexes up or down than gasoline prices. And right now, gasoline prices are the highest they've ever been in the US. So it's likely to push confidence lower. Does that equate to a reduction in spending? It hasn't so far, but I think it's going to start. I think consumers are rethinking their summer plans. I think there's going to be a lot less travel this year, which means less eating out, things like that. But consumers are looking at both the reduction of discretionary spending and concerns about the outlook for the economy and whether this favorable labor market is going to be sustained.
Okay, fair enough. Jolly D then. Okay, anything else from your side, Terry?
No, I will mention in terms of consumer spending, the motor vehicle sales for data for May was a sharp and much below expectations decline. And part of that is a shortage of cars to buy, but also consumers are probably looking at these big ticket items that have seen substantial price increases and or aren't being discounted the way they were. And I think that's going to have an impact on consumer spending as well.
Yeah, fair point. I've got to say, I think we're certainly seeing, I was going to ask you about that, because we're very much seeing a similar pattern across Europe and notably in the UK as well, where we're seeing consumers very much starting to retrench now, just because they've been completely taken aback by a big increase in overall prices, but particularly as mentioned, gasoline, petrol prices, call it what you will, they've been absolutely going through the roof. Okay, brilliant. Thank you for that, Terry. And with that, we'll move across to Europe. And indeed, I guess as far as financial markets over here are concerned this week, the ECB, as I mentioned in the intro, they haven't really been doing a lot in terms of a shift towards any kind of tightening. But this meeting on Thursday should be an interesting one, although that's not going to be so much because of what they're likely to do this month, but really because what they'll probably signal in terms of policy for July and indeed possibly beyond as well. Most of the rhetoric we've had coming out of the bank since April's meeting has pretty well stuck to the current forward guidance that interest rates will not go up until after quantitative easing is completed, and that's not supposed to be until next quarter. So unless the guidance is amended, which certainly some governing council members would very much like to see, and indeed will no doubt be pushing for, it seems that it's going to be a case of no rate hike just yet. That said, there's a clear consensus now that interest rates in Europe are too low, and the market seems to be pretty well convinced the tightening will be taking place next month. The only question then is by how much. Now, the ECB traditionally moves only slowly, with Ukraine effects on the real economy still very uncertain. I guess that a 25 basis point hike is probably most likely at this stage. However, we do now have inflation, as I mentioned in the intro, above 8%. And of course, we've got a 2% target of the ECB over here as well. So not surprisingly, there have been increasingly vocal calls from some of the hawks for a full 50 basis point rise. And few investors now would agree, surely, that as President Lagarde maintains, the ECB isn't behind the curve. Well, so I think most people would see it increasingly well behind. And indeed, for some of these Baltic states, without picking on individual countries, but I mean, inflation in Estonia now currently stands at some 20.1%. Lithuania is up at 18.5% and Latvia at 16.4%. So it's kind of difficult to justify negative interest rates in countries with inflation rates quite as high as those. But to make matters worse, looking forward, as I say, asking Terry what she thinks about in terms of US inflation topping out. Well, producer prices in the Eurozone as of April, we don't have the May data yet, but for April they're up at some 37.2%. And that kind of offers a warning signal that most likely there's really still very strong pipeline pressures to feed through into consumer prices. Indeed, even the core PPI rate at the moment is running up there at 15.6%. Consequently, I guess before we get to the July meeting, which will very much be the focal point in terms of when interest rates are most likely to move, that'll be on July the 21st. Before then, we'll get the June flash HICP number. That'll be released on the 1st of July. Although markets are currently discounting, in fact, they're discounting a little more than 25 basis points in July at this time. But if we see a particularly strong July inflation number, then I guess we're going to see even more pressure on the ECB to come out and do 50 basis points. And it really is a case now, I think, of what they do on Thursday with regards to their credibility. I think by and large, most people don't anticipate anything in terms of rates on Thursday, although it is a possibility. But they really will, I think, have to come out and offer a pretty hawkish signal about what's going to happen in coming months if they're going to maintain credibility with inflation just so far above target already. What else to look for in terms of Thursday? I guess there could well be some further comments to the effect that the central bank's not happy about the extent of the slide in the euro this year. I mentioned it in previous podcasts. The ECB doesn't have a target for the exchange rate, but nonetheless, it has acknowledged that a strong dollar and the counterpart to that being a weak euro has certainly helped to boost inflation in the Eurozone and making it that much harder for them to bring prices under control. And the other big potentially issue to keep an eye on will be what's going on with spreads across the Eurozone at the moment. We've had widening interest rate spreads for the more peripheral EMU countries, the likes of Italy and Greece, versus what's going on in the German market. Those interest rates, or yields, I should say, have risen disproportionately in recent weeks. And that's something which so-called fragmentation of the markets that the ECB want to address. There's been talk of a possible new instrument being introduced to provide support for the more vulnerable markets. And we'll have to wait and see what happens on that one. But it's probably something worthwhile keeping an eye out on, because most definitely the ECB doesn't want to see these spreads continuing to rise, because it would start to imply potential instability across the Eurozone in general. What else have we got? As far as the UK is concerned, we've got the Bank of England meeting here next Thursday, so Thursday week. Still looks likely that we'll get a 25 basis point coming out the Bank of England, which will put bank rate up at 1.25%. However, we got overall economic activity running, if anything, a little hotter than expected. Econoday's economic consensus divergence index is currently standing at 30, so that's quite well into positive surprise territory, meaning that the economic activity in general of late has been running rather faster than the market anticipated. Of course, inflation now, as of the latest figures, running all the way up at 9%. There's no doubt going to be at least some monetary policy committee meters who will be wanting 50 basis points. Data in general has been pretty mixed, it's got to be said. And I guess from what we had from the surveys, particularly a very steep fall in the PMI in May, the composite output index, down to just 53.1 from 58.2. We also have record weakness in consumer confidence. Put that little lot together and it would seem to be painting a picture of what looks to be a pretty decent start to the second quarter by the economy in April, giving way to weakness in May and quite possibly June as well. Now, the Bank of England is expecting no growth in the second quarter anyway, so that won't stop them putting interest rates up. But it may be a reason perhaps why they'll favour 25 basis points rather than a full 50 basis points. One other point I should mention on that also is that, as people might have seen, we had the Queen's Platinum Jubilee celebrations taking place over the weekend and a couple of bank holidays leading up to that. The additional holidays in themselves could affect GDP by perhaps up to 0.5 percentage points off the level of total output in the second quarter. So that will also make for a bit of downside bias to the numbers coming through for June. Other main talking point for the UK is, unfortunately, politics. There was a no confidence vote in the UK Prime Minister Boris Johnson yesterday. He won it, but it was surprisingly narrow, 211 to 148 votes, and that really underlines the government's political fragility, despite its huge Commons majority. Johnson was backed by less than 60% of his MPs, and that's less than the number which supported the previous Prime Minister Theresa May, just 6 months before she felt obliged to resign over the Brexit deadlock. Now he's facing more than 40% of the party wanting him to leave. So although under existing rules there can't be another challenge for the leadership for at least a year, those rules in practice could actually be changed. And in any event, with such a big rebellion against him, he's going to find it very difficult, I suspect, to survive over the course of at least for the rest of this year anyway, and certainly into next year. Key date for the diary will be June the 23rd, when there'll be a couple of important by-elections, one of which the Tories have a huge majority, and were they to lose that, I think pressure on Johnson to stand down may well be such that he simply can't do anything else. Okay, then, what else we got in terms of looking at the central banks? Also looking to next week, we'll have the quarterly Swiss National Bank policy assessment. Again, that will also be on Thursday, so the same day as the Bank of England. No changes there, but watch out for possible confirmation that the central bank has accepted that the equilibrium level of the Swiss franc is stronger than it previously thought. It won't want to see the key euro Swiss franc cross fall below parity, but it does seem to have pretty well given up the idea now of trying to secure a significantly weaker Swiss franc. So that'll be something to keep an eye on there. Rounding off the other central banks developments, Bank of Canada last week, as widely expected, increased their overnight target rate by 50 basis points to 1.5%. And indeed, some of the commentary surrounding that, notably coming out of the deputy governor, really effectively opened the door to a possible 75 basis point hike at some point, and also intimating that rather than stopping at 2.5%, the midpoint estimate for the neutral range for the interest rates, there was now a greater chance of reaching as high as 3%. So it really does look as if things are set for aggressive tightening coming out the Bank of Canada over the course of coming months. And indeed, further evidence that, if you like, 50 is the new 25 in terms of interest rate hikes. Reserve Bank of Australia earlier on today surprisingly steepened its tightening path. It introduced a 50 basis point hike in its benchmark official cash rate. That now stands at 0.85%. That increase was double the market consensus. And I guess really tantamount to admission that, as the markets have suspected for some time, the central bank had significantly underestimated inflation and pressures. So expect more to come there. Indeed, seems now that the Reserve Bank of Australia is starting to move more along the lines of its neighbour, the Reserve Bank of New Zealand, which started tightening well before it, and indeed has been pretty aggressive in so doing. Right, I think that's probably a roundup in terms of the central bank stuff. Last chance for you, Terry. Anything you want to add on top of that little lot?
Not at the moment.
Excellent. In that case, that is it for this time then. I suppose we can say that with a few notable exceptions, central banks are still tightening. Sovereign bond yields are back up at multi-year highs, and no one really knows if inflation can be squeezed out of the system without causing a recession. So financial markets remain volatile and particularly vulnerable to shocks in the data. All of which means that keeping on top of the major economic statistics, policy shifts, and other key market moving events in Econoday's global economic calendar is more important than ever. If you haven't already, do take a look. On behalf of Terry and myself, thanks as always for listening. I hope to see you again next time. Bye for now.